Welcome to the Nifty Noon podcast, and welcome back to the Deep Dive.
Great to be here.
We're your guides today, immersing ourselves in, well, the really fascinating world captured in those Nifty Noon newsletters you sent over.
Mm-hmm.
Our mission today is pretty clear. We want to pull out the most important bits, the key knowledge and insights from this past week, give you a shortcut to being really well informed on what happened in crypto.
And it was quite a week, wasn't it? A really dynamic one.
Absolutely.
We saw, high-stakes stablecoin battles, some pretty serious accusations flying around about insider bias that really stirred up the DeFi community.
Yeah.
But then, completely on the other end of things, we saw the launch, quite unprecedented, really, of a Dogecoin ETF on Wall Street.
Incredible stuff. And that's really just scratching the surface.
Mm.
We'll also unpack what's happening in the NFT world. OpenSea is making some major strategic shifts.
Right.
And we're seeing this ongoing institutional embrace of digital assets, even when there's, significant controversy swirling around.
It really was a week where innovation, regulation, and maybe, a bit of drama all came together, paints a vivid picture of where crypto is right now.
Exactly. So to give you the clearest possible picture, we're going to walk through these developments chronologically. We'll start back on September 8th and move right through the week to September 12th.
Sounds like a plan. Let's get right into it.
Okay, let's kick things off then, September 8th. There was an incident that I think really highlighted some of those core tensions in crypto. The WLFI wallet freeze.
Ah, yes.
The headline from our newsletter was pretty punchy. "You're fired. WLFI freezes Justin Sun's funds."
Huh.
This wasn't some minor thing. It became a real flashpoint almost immediately.
And what's striking straight away is, who was involved? Justin Sun. He's a huge figure in crypto, often controversial. And he publicly called out World Liberty Financial, WLFI, that's the project, with links to Trump accusing them of, and this is his word, unreasonably freezing his wallet.
Wow.
Basically blocking him from moving his WLFI tokens. Which, in a space built on decentralization and individual control, that's a pretty big accusation.
Yeah, and the timing was interesting, too. This freeze happened right after WLFI's token price had taken a nosedive, just after its market debut.
Exactly. And then people started digging into the on-chain data, the public transaction records.
Right.
And that data showed some pretty large transfers of WLFI tokens coming from wallets linked to Sun, moving to other addresses.
Ah, okay. So the immediate thought was...
he's getting ready to dump his tokens, right?
Right.
Which would only make the price fall faster. That was the speculation.
But Sun pushed back on that.
He did. He denied it flat out. Said they were just tests, claimed they had no market impact.
Tests. Okay, so you've got Sun's side. What about WLFI? How did they respond?
Well, this is where you get that classic battle of narratives. WLFI defended the freeze. They said it wasn't targeted at Sun specifically, but was actually a broader security measure.
A security measure?
Yeah. They claimed they targeted hundreds of wallets to protect users against phishing attacks. Their line was they only step in to protect users, never to stifle legitimate trading or silence anyone.
Okay, so Sun says unreasonable freeze. WLFI says security protocol. What did the actual data show in the end? Was Sun really crashing the price?
That's the crucial part. Deeper analysis, looking beyond the initial noise, suggested the price crash was actually driven more by broader shorting and dumping activity happening elsewhere.
Ah.
And interestingly, Sun's largest transfer actually happened after the price had already dropped quite a bit.
So the cause and effect wasn't as clear-cut as it first seemed.
Exactly. It looks like there might have been a bit of a rush to judgment, pinning the blame on Sun when the reality was maybe more complex. And despite all that drama, our newsletter did note the token was actually up about 40% since that blacklisting incident.
Crazy. So what's the big takeaway here for our listeners?
I think this WLFI saga really forces us to confront those fundamental questions about centralization and trust in crypto. I mean, when a project team, even for stated security reasons, has the power to just unilaterally freeze a major investor's funds, that directly challenges the whole decentralization ethos, doesn't it?
It absolutely does.
It highlights this tension between security, maybe usability, and censorship resistance. So for you listening, it really underscores why it's so important to look closely at a project's governance. How much control does the core team keep? What does that mean for your assets? It's a stark reminder that, not all crypto projects are equally decentralized.
That's a really critical point to remember. Okay, let's shift gears. Moving on to September 9th, our newsletter brought us news about OpenSea making some pretty significant strategic moves. The headline was, OpenSea announces NFT treasury, new mobile experience, and Cyan token update.
Yeah, this was big. It signals a very deliberate evolution for OpenSea, which has obviously been the dominant NFT marketplace for a long time.
So what's the change? What are they becoming?
They formally announced they're evolving beyond just an NFT marketplace. They're aiming to be a, quote, comprehensive on-chain trading platform.
Comprehensive on-chain trading. That sounds like a broader scope.
It is. It feels like a reflection of the NFT market itself maturing, right? Moving beyond just, profile pictures towards more integrated utility across different kinds of digital assets, different chains. And OpenSea clearly wants to lead that next phase.
Makes sense. So what are the concrete changes? What new features are coming?
Well, two big things stand out. First, they're launching a new mobile app. It's described as AI native, designed for really seamless trading across all your wallets, different blockchains, different types of assets. The goal seems to be making crypto interaction as smooth as any other mobile app you use.
Okay, improved accessibility. What else?
The second thing, which I found quite interesting, is the flagship collection.
Flagship collection?
Yeah, it's a formal reserve, like an internal fund. They're committing over $1 million initially to acquire historically significant NFTs, but also works from emerging artists.
Oh, wow. Like a museum, almost.
Kind of. Their first big purchase was CryptoPunk #5273 for about $283,000. It feels like a move to really cement their cultural credibility in the space, maybe push back against the idea that NFTs are just fleeting hype.
That's a smart play. But the headline also mentioned the SEVIA token update. That's the one people have been waiting for, right?
Definitely. Huge anticipation around their native token. So they announced the final rewards phase before the actual SEVIA token launch begins on September 15th.
Okay, final rewards phase. How does that work?
They're taking 50%, half of all platform fees, and sweeping them into a prize vault. And they kickstarted it with $1 million worth of OP and ARB tokens.
That's a serious incentive.
It really is. The idea is users get these treasure chests based on their activity, and you can level them up by using the platform or trading, listing, etc. Higher levels mean bigger shares of the rewards, potentially including some high-value NFTs.
And what about people who've used OpenSea for years? Did they get recognized?
Yes. Crucially, they confirmed that historical platform usage will also get a separate SEVIA allocation, so rewarding those early adopters, too. They expect to share the full details about the token generation event, the TGE, that's the official launch and distribution, sometime in early October.
Got it. So big moves from OpenSea. Did our newsletter mention anything else happening around that time that puts this in context?
Yeah, a few interesting snippets. There was a large-scale supply chain attack that compromised something called an NPM account. Only $159 was stolen directly, but NPM is critical infrastructure for a lot of software, including Web3 stuff, so a vulnerability there is always worrying.
Okay, security concerns still present.
Right. And sort of contrasting OpenSea doubling down on NFTs, there were reports that Christie's auction house is actually shutting down its dedicated digital art department.
Oh, interesting divergence there.
Definitely shows the mixed signals still coming from the traditional art world towards NFTs. And finally, just another bit of stablecoin news. Mega USD, or USDM, was introduced. That's the native stablecoin for Mega ETH. Just highlights that constant innovation drive for new digital dollars.
So putting it all together, these OpenSea moves,
Yeah.
they really signal a maturing NFT market, don't they? Shifting maybe from pure speculation towards utility, accessibility, cultural value.
I think so, and
Yeah.
driven by the big established players trying to solidify their position.
And for you, the listener, what does this mean? Maybe greater stability, easier ways to interact via mobile apps.
Potentially, but also maybe a consolidation of power around these major platforms like OpenSea. It's kind of a double-edged sword, right?
Yeah.
More user-friendly, perhaps, but maybe less decentralized in practice. Something to watch.
Definitely something to watch. Oh yeah, let's move to September 10th. This was the day we got news that frankly sent ripples through both crypto and traditional finance. The headline, Wall Street unleashes the DOJE.
Yeah, this one was unexpected, to say the least. The start of the meme coin ETF era, apparently.
You heard that right. The first U.S.-listed Dogecoin ETF, ticker DOJE, from issuers RX Shares and Osprey funds, is actually scheduled to start trading this Thursday.
A Dogecoin ETF. on Wall Street. It's kind of wild when you think about it.
It really is. Who would have predicted that a couple of years ago? Shows how fast perceptions can shift, I guess.
And what's really fascinating is how they're doing it, the regulatory path they took.
Right. It's not the same as the Bitcoin or Ether ETFs, is it?
No, completely different. They're using the Investment Company Act of 1940. That's the framework typically used for mutual funds, more traditional ETFs. It's not the same path the spot crypto ETFs took, which faced, much more scrutiny about the underlying asset itself.
So why that route? Does it make it easier?
It seems so. Bloomberg analyst Eric Balchunas had a great quote. He noted, "It's likely the first ever U.S. ETF to hold something that has no utility on purpose."
Huh. Brutal, but maybe accurate for DOJE.
But the point is, this structure might let regulators view it more like a traditional security wrapped in an ETF structure rather than directly approving the underlying crypto asset itself. It sort of sidesteps some of the stickier crypto-specific regulatory questions.
Clever. But it's not like the floodgates are wide open for all altcoin ETFs now, is it?
Not at all. And that's the other side of the coin from that day's news. On the very same day the DOJE ETF got the green light for launch, our newsletter reported the SEC delayed decisions on 2 other proposals.
Which ones?
Bitwise's own Dogecoin ETF, a different proposal, and Grayscale's application for a spot Hedera ETF. Both got pushed back to November 12th.
Okay, so delays elsewhere.
And Grayscale, never giving up, also filed paperwork to try and convert their Bitcoin Cash and Litecoin trusts into ETFs. The queue is long. Apparently, nearly 100 crypto ETF filings are sitting there waiting for approval.
Wow, 100. So the regulatory environment is still complex, fragmented.
Very much so. It's definitely not a simple picture. But if you look at the broader institutional activity mentioned in our newsletter around the same time.
What else was happening?
Well, NASDAQ filed with the SEC to allow trading of tokenized equity securities and tokenized ETFs. That's a big push towards putting traditional assets on chain.
Okay, TradFi leaning in.
And Fidelity, kind of quietly, stealth launched, was the term, used a money market fund directly on Ethereum. It already holds $200 million. That's significant adoption, even if it wasn't splashy news.
$200 million isn't quiet.
Exactly. Plus, U.S. Senate Democrats shared a framework for market structure legislation showing regulators are actively thinking about this. And Gemini announced plans to go public on NASDAQ, aiming to raise over $300 million.
So lots of institutional movement, even with regulatory caution.
Precisely. While the SEC might be slow or selective on specific ETF approvals, there's undeniable momentum from institutions engaging with digital assets in various ways.
So let's try to make sense of this. We've got a Dogecoin ETF launching, but SEC delays on others. What does this contrast tell us about crypto's integration into traditional finance? What should you, the listener, take away?
I think it suggests the integration won't be uniform. It'll be nuanced, maybe even piecemeal. Different assets, structured in different ways, might face different regulatory treatments.
So the 40 Act wrapper for DOJE might be an easier path than a pure spot ETF for something like Hedera, for now at least.
That seems plausible. It means you should probably expect this kind of mixed signal environment to continue. Some things move forward quickly, others face delays. It signals the need to be adaptable in how you interpret market access and regulatory wins. It's not all going to happen at once.
Good advice.
Oh.
Okay, shifting to September 11th. Now we dive into a really high-stakes competition, a proper battle shaping up in the DeFi space. Our newsletter called it the battle for the Hyperliquid stablecoin throne.
Yeah, this was a fascinating governance drama unfolding on the decentralized exchange Hyperliquid, and there was a lot of potential value up for grabs.
Okay, unpack this battle for us. What was the core issue?
So Hyperliquid, the DX, was looking for an official issuer for its native stablecoin, which they call USDH.
Okay, and native stablecoin, why is that such a big deal for them?
It's about capturing value currently leaving their ecosystem. Right now, users on Hyperliquid primarily use USDC, right? Billions of dollars worth, maybe around $5.5 billion was the estimate.
Wow.
The platform generates yield from those assets, but currently that yield doesn't directly benefit Hyperliquid or its token holders. By having their own native stablecoin, USDH, issued by a partner, they could potentially recapture a huge chunk of that way.
Revenue estimates were over $200 million annually.
$200 million a year. Okay, I see why they'd want that and why issuers would fight for it.
Exactly.
Yeah.
Securing the deal to issue USDH on Hyperliquid meant potentially managing billions in assets and sharing in that revenue stream. It's a massive opportunity.
So who were the main contenders throwing their hats in the ring?
It was a roster of heavyweights, really.
Yeah.
You had Athena, Paxos, Sky, which used to be MakerDAO, Agora, Frax Finance.
Yeah.
All major players in the stablecoin or DeFi space submitted proposals.
And what were they offering? Hyperliquid. The competition was intense, so the offers were very generous. Most were proposing to share 95% to 100% of the revenue generated from the stablecoin's reserves back to the Hyperliquid ecosystem.
95 to 100%.
Wow. Yeah, typically through buying back Hyperliquid's native token, HYPE, or funding ecosystem grants. Athena's proposal was particularly interesting. Their stablecoin would be USDTB, backed by BlackRock's tokenized money market fund, BUIDL, and they pledged 95% of the net revenue back.
So high stakes, big names, aggressive offers. How is the winner going to be chosen?
That's the DeFi part. It was slated for an on-chain vote by the network's validators, scheduled for September 14th. So theoretically, putting the decision in the hands of the decentralized network participants.
A proper governance showdown. And were there other significant institutional things happening around this time, according to our newsletter?
Yes, quite a bit, actually. There was chatter about whales and funds increasing their accumulation of COL, Solana, anticipating the SEC's decision on Solana spot ETFs. Suggests bullish sentiment there.
Yeah.
We also saw a publicly listed company in Hong Kong, QMMM Holdings, announce plans to put Bitcoin onto its treasury balance sheet. Another example of global corporate adoption.
Right.
And perhaps most significantly, news emerged that BlackRock itself plans to tokenize its ETFs and put them directly onto the blockchain.
BlackRock tokenizing ETFs.
That's huge. It's potentially transformative for how traditional finance interacts with blockchain rails. And Galaxy Digital CEO Mike Novogratz commented on this, saying the regulatory push for tokenization seems to be aligning perfectly with Solana's readiness for financial markets. He even called it the season of Sol.
Season of Sol. Okay. So a lot of institutional momentum building in the background while this Hyperliquid battle brewed.
Absolutely. These things aren't happening in isolation. It's all part of this broader integration trend.
Okay, let's bring it home then. The final day we're covering, September 12th. Our newsletter headline really captured the turning point. Is native markets poised to win the Hyperliquid stablecoin showdown? This takes us to the climax and introduces a bit of controversy too.
Indeed. The whole competition took a very decisive and perhaps surprising turn. Athena, who many saw as a frontrunner with that BlackRock-backed proposal, they officially withdrew their bid.
Athena pulled out.
Why? The stated reason, or at least the public narrative, was framed quite positively. But their withdrawal left a much newer entity, native markets, as the clear, overwhelming favorite.
Native markets. Who are they?
Relatively new, co-founded by someone who is actually an early investor in Hyperliquid itself.
Ah, okay. An insider connection, potentially.
Potentially. And with Athena out, the prediction markets, which often reflect informed speculation, suddenly gave native markets over a 92% chance of winning the validator vote. It looked like a done deal.
How was this framed publicly? Did Athena say anything else?
Well, in what seemed like a gesture of, sportsmanship, Athena's founder publicly congratulated native markets. He even framed their emergence as a positive example of Hyperliquid's open ecosystem allowing new players to rise.
Okay. And what about Hyperliquid itself? Did the foundation weigh in?
To emphasize the decentralization aspect, the Hyperliquid Foundation actually pledged to abstain from the vote entirely. They said they would let the validators decide without any central influence. On the surface, it looked like a textbook case of fair, decentralized governance in action.
Right. Sounds good on paper. But you mentioned controversy.
Yeah, despite that positive framing, the whole process drew significant criticism from some very respected voices in the industry.
Like who? And what were they saying?
Well, Hasib Qureshi from Dragonfly Capital, for example, publicly called the bidding process a bit of a farce.
A farce. Strong words.
Very. The underlying implication from him and others was that native markets might have had some kind of unfair advantage, maybe advance notice, or that the process wasn't truly open from the start.
Why do they think that?
Critics pointed to native markets being a brand new team, lacking the established track record of issuers like Paxos or Agora. They questioned how this new entity managed to secure such overwhelming validator support so quickly, suggesting there might have been some prearranged deals or, well, insider bias due to that co-founder's connection.
So questions about credibility and the fairness of the validator lobbying process. How did native markets respond?
To their credit, native markets did acknowledge they needed to prove themselves. They seemed aware of the skepticism surrounding their sudden rise.
Okay, so this whole Hyperliquid saga, it really wraps up a lot of themes, doesn't it?
Right.
Innovation, competition, governance, and these persistent questions about fairness and DeFi.
Absolutely. Especially when there are hundreds of millions of dollars at stake annually, the concerns about potential insider bias, even if they aren't definitively proven, are a really critical reminder for everyone in the space.
Living reminder.
That decentralized on its own doesn't automatically guarantee fairness or immunity from influence, right? It highlights just how crucial truly transparent governance frameworks and active community oversight are.
Yeah. Otherwise, the promise of decentralization can get chipped away by, well, familiar human dynamics, power plays, insider network.
Exactly. So for you, the listener, it really emphasizes the need to look beyond just the code or the white paper. Understand the real-world decision-making processes, the community dynamics, the potential influence points within a supposedly decentralized project. That's where the real trust lies, or sometimes where it breaks down.
A very important point. Before we wrap up, any final market notes from our newsletter on the 12th?
Yeah, a quick snapshot. Bitcoin reclaimed $116,000, showing continued market strength. Avalanche announced plans to raise a whopping $1 billion for 2 crypto treasury companies, aiming to buy millions of AVAX at a discount. Huge confidence signal there.
1 billion. Wow.
And another interesting TradFi crossover. Sharps Technology, which is listed on NASDAQ and holds Solana, announced a partnership with the NFT project Pudgy Penguins, specifically for Solana digital asset treasury exposure, more convergence.
Pudgy Penguins and NASDAQ.
Okay.
And finally, regulators in Hong Kong proposed easing capital rules for banks holding crypto, signaling a potentially more favorable environment over there.
Got it. So a busy end to a very busy week.
Definitely.
Well, thank you so much for joining us on this deep dive through the recent Nifty Noon newsletters. We really hope you're walking away with a clearer, sharper picture of this constantly evolving crypto landscape.
Yeah, from the big market moves and platform strategies to those crucial, sometimes messy governance discussions and the ongoing dance with the regulators.
And if you found these quick daily crypto insights useful and you want to stay ahead of the curve, you can follow our newsletter, Nifty Noon. It's available on X and Substack. We definitely recommend it.
Absolutely. Great way to keep up daily. So as we wrap up, reflecting on this week, we've seen crypto pushing hard for mainstream adoption, right? ETFs, tokenization from giants like BlackRock.
The integration narrative is strong.
But at the same time, we're seeing these internal struggles. The WLFI freeze, raising centralization flags, the Hyperliquid drama sparking concerns about insider influence in DeFi governance.
Yeah, those foundational principles are being tested.
So here's a final thought for you to chew on this week. How much compromise on those core crypto principles, things like decentralization and open governance, is actually acceptable in this push for broader market integration? Can these two forces, mainstream adoption and decentralized ideals, truly coexist peacefully in the long run?
That's the billion-dollar question, isn't it?
It really is. Something to think about. Thanks again for tuning in.